In this week's video, we'll review the latest charts and historical data to help us answer the question, could bonds trounce stocks in the coming months? We'll be moving quickly, so feel free to use the pause button on your video player. As we all know, the Fed has been raising rates rapidly in calendar year 2022. Thus, it's logical to ask and answer some questions about recession probabilities and the potential impact on earnings. And during the course of the video, either directly or indirectly, we'll be covering 3 stock bond scenarios, key bull-bear levels to help us assess probabilities, and then we'll look at a wide range of charts to see what we can learn. This week, Jerome Powell, November 30th, he acknowledged that inflation remains far too high, hence why they've been raising interest rates so rapidly. And we know interest rate policy tends to work with a lag. In a previous 2022 video, we covered this topic, how recessions are determined, and we covered all of these charts here in that video. If we did so again, we would draw the conclusion that it's not likely that the economy is currently in a recession. Are we starting to see some cracks that say we may enter a recession sometime in the coming months? Let's start with the sham rule. Blue box, upper left-hand corner of your screen. The Fed has never achieved a soft landing when it had to push up unemployment significantly. The sham rule says a recession, for the most part, or at least historically, is inevitable when the 3-month moving average of the unemployment rate increases by 0.5 percentage point. You can Google this title here to find a Bloomberg opinion piece on the topic, but the Fed is on record recently that they believe they're going to have to push the unemployment rate up to get inflation under control. If we review some basic math in the context of history, it's very difficult to see how the Fed can bring inflation under control and avoid a recession. And it's possible that we could end up in a scenario that's not as benign as the one the Fed has been describing. It's a graph of unemployment claims going back to 1996. Remember, I said if we reviewed these charts, they really don't look recessionary. Using this data set and the data sets that follow, what we're trying to determine is, do we believe that these charts are about to deteriorate or start to take on a recessionary look? It's the 50-period moving average in blue, just trying to discern the trend in unemployment claims. Nothing binary here or earth-shattering, but for the most part, when we move above an upward sloping moving average like this, as we did in the year 2000, and as we did here in 2007, early 2008, common sense tells us that the probability of a recession becomes elevated. This box over here is a zoomed-in look, this area of the chart here with price removed, allowing us to look at the moving average, and we can see the trend starting to flatten out. It has not turned up yet, but there's no question the trend looks a little bit different down here than it did up here. And there's also no question that the trend looks different than it did in this area here. So we have price above currently, and we have a flattish moving average. Similar situation with continuing claims. Headline from this week, get that turning look here in the year 2000, the turning look here in 2007, the S&P 500 peaks in October of 2007. This is the financial crisis look here. Industrial production, you can see the rollover look in the year 2000. S&P 500 peaks here in March of the year 2000. Rollover look starts in Q4 of 2007. S&P 500 peaks in October of 2007. If we zoom in on the same data set, it's probably fair to say that the momentum is waning. Q4 of 2008, really max fear in the financial crisis, and you can see University of Michigan consumer sentiment improved walking forward for the most part. 1990 period in here, stock market makes a low. You can see sentiment improves. 1982, sentiment improves. We really don't have an improving look in 2022. A little bit of improvement, but difficult to say this move here is really that much different from this pop here or this smaller pop here. Still a pretty depressing look. Case-Shiller Home Price Index, S&P 500 peaks right in here, October of 2007. We do have a rollover look in 2022. Again, from a recent video, 3-month 10-year yield curve, recent inversion here. You may remember the 3 cases that have similar ugly technicals relative to the present day. After a similar inversion of the yield curve, the additional loss in the S&P 500 was roughly 45%. Doesn't mean we're going to drop 45% in the present day. It just tells us, historically, this type of inversion can tell us recession probabilities are increasing rapidly, which typically is not good for stocks. And you may be able to make an argument today is different. We didn't have high inflation here in the dot-com bust. We didn't have high inflation here, financial crisis. But you can't say that about June 1973. And after a similar inversion, the S&P lost 40%. Additional look over here, left side of the screen on the same topic. Walking down the common sense aisle again, if the economy goes into a recession, probably fair to say that earnings per share, S&P 500 earnings per share, will take a hit. This little blurb over here, upper right-hand corner of your screen from CNBC, November 29th, will help us understand the basic concepts covered in this segment of the video. Assuming earnings will be flat next year and the market remains at an historic average multiple of 17 times, this is a PE multiple, the value of the S&P 500 is currently $37.40. The S&P 500 closed over 4,000 on Friday, December 2nd. Let's take the math in the blurb here and do some simple edits. For heading into a recession, probably not fair to say that earnings would be flat next year. So if earnings drop by 10%, your 220 goes to 198 hypothetically. And let's also assume that the multiple or the PE on the S&P 500 drops. 198 times 15 is 2970. Takes you to that roughly 3,000 level that we've been talking about for some time. Chart over here is from Morgan Stanley. Their leading earnings model basically says they're expecting earnings per share to drop significantly. It's a great table here. Here's the source of the data. Average recession lasts about 10 months. And assuming that earnings would be flat next year doesn't really mesh up very well with history. Average earnings per share decline in these recessions down here, almost 30%. If we take out the financial crisis and the dot-com bust, average earnings per share decline in a recession, probably closer to 19 or 20%. The table contains the specific percentage drop in earnings in each recessionary case. So let's take this simple concept over here and do some simple math. If we assume earnings end 2022 at roughly $220 a share, if we entered a recession and they declined 17%, they'd be 183. The historical multiple here times earnings would net you an S&P 500 level hypothetically of 3104. If we do that, for each one of these recessions shown in the box here, in a recession scenario, history says earnings could drop 20% and the S&P 500 could drop 20 to 30% from the December 1st closing price. The average S&P 500 hypothetical drawdown from December 1st would be about 35%, the median about a 26% drop. You can pause your video player here. Tuesday, November 29th, Morgan Stanley, you should expect an S&P between 3,000 and 3,300. Meshes up very, very well with the meat of this table here. Morgan Stanley, the bear market is not over. We've got significant lower lows if our earnings forecast is correct. Another quote here, left side of your screen, talking about yield curve inversion. Last seen since late 1981. Here's late 1981 here. The S&P 500 in late 1981 to this low here in August of 1982 gave back 19% in round figures. This was Morgan Stanley, JP Morgan from CNBC, November 30th. Basically saying they don't think it's over. We are inclined to think this market decline could happen between now and the end of the first quarter 2023. You may remember from past videos, we also looked at durations. Right here, hypothetical bear market end, late January 2023, based on average and median outcomes. S&P 500 level, roughly 3,200. Thus, if we avoid a recession, it is reasonable to think the lows may be in. For heading into a recession, history says 2782, based on this high here, is within the realm of possibility. The median recessionary bear market dating back to 1929 would take you down here, just a little bit above 2,900 on the S&P 500. The average recessionary bear market, we'd undercut hypothetically 2,800. And in that case, your hypothetical end would be late April of 2023. Shifting gears, updating the charts that we covered last week. All of these are as of Friday's session, intraday. Hovering right around the thin downward sloping trend line, 200-day moving average. You can see for the most part the 200-day has been helpful from both a bullish and bearish perspective. If we zoom in, based on pivot resistance now, upside potential, our potential resistance up here, 43.35. That's not a forecast in any way. It's just saying if price did get up here, it could act as potential resistance. The 42.33 is based on this solid red anchored volume weighted average price line here that you can see has been relevant in the past. Capped the recent rally here. This is August 16th. If we came back to the thicker downward sloping trend line, in a very, very similar area to that red line, sits now at 42.33. All of these levels, areas that could act as both support and or resistance based on where price is. Being in this area here near the 200-day moving average and near the downward sloping thinner blue trend line, the market is more vulnerable here, but daily momentum down here really hasn't rolled over yet in any meaningful way. Still a relatively strong look in here for the most part. Covered this chart in detail last week. This is what it looked like this week when the S&P 500 was trading at 40.62. It's a big band of volume weighted average price in here. These are anchored and potential cloud resistance for the most part in the same general area. This top line here is 42.34. This horizontal line here is 42.27. It's important to note that all of this represents possible resistance. These are bull-bear guideposts. Price could blow right through all of this if it chooses to, and if it did, we would learn something about improving bullish probabilities. Always have to have realistic expectations about what these tools are used for. We use them to assess probabilities, the probability of good things happening relative to the probability of bad things happening. The probability of bad things happening is never zero. And as with most methods, we can really discern the same basic message by just interpreting price. This is Friday, December 2nd at 2:12 p.m. Eastern Time. This is the 205-day moving average. Why 205? It just happened to be the area that bounded price here on August 16th. In that same general area now, and also near a downward sloping trend line here. If we draw a trend line from here to here to here to here, that comes in somewhere in the neighborhood, hypothetically around 4,200. We also have a gap in that area at 42.18 up here. It's not a binary situation. That's why we always say, if we get out here, the longer we remain above a 205 or 200-day moving average, the more relevant it becomes. It's not particularly shocking or earth-shattering if we close above it for a few sessions. Markets like to overshoot. We have to be ready for an overshoot potentially in the present day, even under a bearish scenario. So all of this, including the retracements here, which are in these boxes here, same basic message here on the weekly and same basic areas, we can discern that with price. If I draw a horizontal line here between this point and this point, I really only hit price a few times. If we're up here and we draw a horizontal line, we'll hit price multiple times. It's relatively easy to move from this cluster to this cluster if we continue to push higher, and this is 4,300. Doesn't say we can't do it. It's just harder than this move here. It's harder than this move here. Based on the primary trends, we're still in scenario 3 now. If the stock market fails to break through overhead resistance, possible resistance, so let's say the S&P 500 can't trade above its 200-day moving average for any length of time, more than just a few sessions or a couple of weeks, then scenario 2 will start to gain some traction. If risk assets, primarily stocks, can break those downtrends, The longer they stay in breakout mode, the higher the probability that we're looking at a scenario 1. And if stocks and bonds both fail to break their downtrends, they're still in downtrends, and we may be right back here. Covered this many times. You can pause your video player. Bottom in 2003, bottom in 2009. This is the S&P 500 down here. Not particularly impressive as of December 1st. The risk-on rally that we had earlier in the year from June, let's say, to mid-August, that was based on scenario 1 expectations. And for numerous reasons, this is what scenario 1 should look like on this chart. This is what scenario 1 looks like today. Stock market's been rallying for several weeks, and unlike this period in here, not a whole lot of progress here. You can make an argument that this in here and this higher low here is similar to this look here, but it's late to the party. We've been rallying again for several weeks. And in this case, this low was made before the S&P 500's low that was made in June. And if lower rates and lower inflation is this look over here, 200-day moving average slope decidedly down, 50-day moving average slope decidedly down, and price well below both. When we talk about trying to discern between a counter-trend move within the context of a primary downtrend and having the downtrend flip back over to an uptrend, one of the primary concerns in the present day is monthly momentum. This is the Copic curve. This is what the present day looks like. You can see it looks quite a bit different than anything that we've seen here prior to this financial crisis look here. Another similar look here during the dot-com bust bear market. Now, it's possible we're more like a 1984 scenario, but we have to see some improvement over here. This chart goes back to 1988. Very similar concerns, a similar message. Present day monthly RSI over here looks worse than this point here in 2008. This is happening above 50. This is happening below 50. You can probably make an argument that the present day here looks a little better than this attempt here, but similar. This looks different relative to all of this. This is 2010 here. Similar concepts here. Weekly RSI. The two horizontal lines down here, we'd like to clear those to take on more of a bullish look and move away from these types of bearish looks. During Friday's session, weekly near that bull-bear demarcation line, and here this is also the 200-week moving average of bull-bear demarcation line. Rally failed in a similar area here in August, failed in a similar area here earlier in the year. Downtrend starts back here. We'll learn something about the scenarios based on what happens in the coming weeks. Right now, we're tending to stay near the 200-week. So this is a weaker look in here than this stronger bounce back here. Broad Dow Jones Composite. This is a weekly chart. It's 1:36 p.m. Eastern Time on Friday, December 2nd. Right now, it doesn't look discernibly different from the existing downtrend and the other counter-trend rallies. Momentum down here does look a little bit better. So it tells us to keep an open mind about a breakout occurring. It hasn't happened yet, but it still may occur. Made a nice stand here at an upward sloping and important 200-week and near logical levels here. If we look at the weekly cloud during Friday's session, this is an area of potential resistance. Very similar message to what this line is telling us. Dow Jones Industrial Average, Friday's session, 1:40 p.m. Eastern Time. Is this going to be a successful breakout or a failed breakout? Right now, it still looks like a successful breakout. Notice how much different this looks than all of this. Longer it holds, the more meaningful it becomes. This chart leans bullish. If you pause your video player here, this also tells us to be open to better than expected outcomes. This is a massive monthly candle back here last month. That's rare. Try to find a candle like this in one of these downtrends. It's difficult to do. This is your scenario 1 look in here. The present day, a lot weaker. One of the things that we'd like to see to feel better about longer-term bullish outcomes, we'd like to see price on any major index above an upward sloping 200-day in red. This is Friday's session, NYSE Composite, the 200-day, not upward sloping. That tends to look more like a counter-trend move. Thus far, the S&P 500 has not cleared this area here, this gap, in a convincing manner, and during Friday's session also near a downward sloping 200-day, but above an upward sloping 20-day shown in blue. It's the monthly cloud over here, blue and red. This is a very, very important point, just as these lines are important. Price breaks below and moves in this direction. That's quite a bit different than price breaking in this direction and having blue push back above red. Right now, blue is slightly below red on the monthly cloud. From a bullish perspective, at this point it's noteworthy that this gap up here in early November, this is the CPI gap, we're really nowhere near it during Friday's session. So right now, this is still a good look. If we come back down and fill that gap, like many of these other charts, we'll learn something near the gap and learn something near this upward sloping 50-day in blue. We don't want to get overly wound up about the S&P 500 trading above a 200-day moving average. We traded above the 200-day moving average for several sessions here earlier in the year. Didn't really do anything from a bullish perspective. That's why we say the longer above, the more meaningful it becomes. This is the 200-day moving average in 1994. This is the S&P. Right now, we're hanging around a downward sloping 200-day. I want to keep an open mind about a wide range of outcomes. Here's a W look with momentum down here, S&P 500 weekly. This is the true strength index. There's your W. This is a bullish outcome. We have a W look in the present day. It's a little weaker because we're further below the zero line, but this looks similar to this, and in some ways a little bit better. It's upward sloping. If we do get a breakout with price, this is the momentum look we'd like to see. This is the momentum look we have currently. This is the bearish look. You fail below zero, and your momentum and price looks weaker. Similar situation here in the '08 case. During Friday's session here, this is the 30-week moving average. This is a little bit better look. It's still downward sloping, but it's starting to flatten out a little bit. That's encouraging. Got this area of potential resistance. The rally on the weekly chart failed here, and it failed here, and the downtrend started here. Weekly momentum. If you're a bear, this is the look you would prefer. This is the look you would prefer. During Friday's session, we don't have anything like that yet. Similar concepts with the ETF, SPY, near an important area. Have a lot of charts with this fan type look, where we've got one trend line that we may be at now, and then there's another trend line above it. So in this case, this is SPLG. It's very, very similar to SPY. It really has two hurdles to clear. The trend still looks good here if you looked at this on a larger chart. A lot going on relative to the scenarios here. Interest rates have been falling. It's typically a good thing for stocks. And this is starting to shift. If we compare expectations for the federal funds rate, they're getting tamer now. They're getting more friendly. If we compare the odds here relative to where they were a month ago, it's reflecting this here. It's also saying right now the market thinks the Fed will be able to stop at a lower terminal rate. That's a little bit of a shift, and a favorable shift. The longer it remains, the more relevant it becomes. Here's the big but, though. Notice here, this is October 24th. TLT, defensive TLT, beating SPY. Beat SPY by 1.37% during Friday's session, and TLT beat SPY by over 3% for the full week. What does that mean? That would tend to align more with scenario 2, that the market's expecting a recession sometime in the coming months, where bonds have an edge over stocks. Like anything else, the longer this look remains, the longer this trend remains in place, the longer this ratio favors TLT over SPY, the more relevant it becomes. Flips will learn something. A lot of information here, here, and here. We're back to an area where it would be logical, potentially, for the 10-year yield to bounce. What once acted as resistance may now act as support, may now act as support. The dollar did not hold a similar look recently, which is also very relevant. Like a lot of other charts, we could talk a lot about the VIX. So the VIX was down on Friday. That's relevant. That was one of the reasons to keep an open mind about the market rallying off the lows intraday on Friday, which it eventually did. The session didn't start that way. The VIX was positive in the morning, and it shifted, as noted on our Twitter feed. We don't want to get too wound up about the VIX one way or another here. This is basically, we're back to the same level here. This is where the August rally ended in the S&P 500. Back to the same level here where this counter trend move ended in March of this year. We don't want to extrapolate. We can't assume that this look here is going to look like this and it's going to look like this. That's to be determined. The pattern recently has been when the VIX gets down below 20, stays there for a while, eventually it shoots back up. And the pattern, short-term pattern, and patterns can be broken, the S&P also peaks, the rally ends. Like many of these other charts, if that pattern breaks, we'll learn something. I already talked about the monthly cloud. We zoomed in on this. You can see here, blue drops below red. This is the dot-com bust bear market. So the look that we have in the present day is similar to this look right here, and it's similar to this look here in 2008. So if we deviate from this look or deviate from this look, that's bullish. If price ends up being below both red and blue is below red, that's the look the bears want. This look and this look. If you're a bull, you want to look more like this after the major low in 2009. Like many charts, let's see what happens with VTV up here near all of these gaps. This is the intra-year high here. This is Friday's session. This move off the October low from a trend perspective, unequivocally still intact. There is a divergence with RSI. Price here is higher, quite a bit higher than price here. Daily RSI higher here, lower here. Here's your risk-on look, XLY divided by XLP. It's growth-oriented consumer discretionary divided by staples. This is a tepid look thus far. Now, it's possible that this look in here is similar to this tepid look here. If we move in this direction, down, we'll learn something about the scenarios, and if we take on a look like this, we'll learn something about the scenarios. This weekly look of emerging market bonds here above the 30-week moving average that's flattening out, and all of these nice-looking candles, it says the odds are increasing relative to inflation cooling and interest rates peaking. That would be the bullish side of the equation. The bearish side is EMB was down Friday, 0.44%, and it was down near an area of potential resistance. But this looks very good over here. It tells us to keep an open mind about the S&P 500 breaking out and this box being relevant. The longer above, the more relevant it becomes. Just as it's relevant if we take on a look like this. This is mid-August here. Inflection points all over the place, possible inflection points. The dollar tells us a lot about the relative probabilities of many topics. Back to an upward sloping 200-day moving average. If it blows through it like this, we'll learn something. This is after the COVID low in 2020. If it bounces at this area of potential support, then we'll learn something about all of the scenarios. Like interest rates, right now, this is a counter-trend move within the context of a longer-term uptrend. We talked about corporate bonds. Credit markets tell us a lot about recessionary probabilities. Right now, this is LQD, investment-grade corporate bonds, diversified basket. This is a good look over here relative to some important areas. The longer it holds, the more meaningful it becomes relative to the bullish case for bonds, and in some respects, the bullish case for the economy and stock market. See this gap here? Back to that gap. So we'll learn something here, but this is some nice looking momentum. This tells us it's very possible that this breakout is going to hold. Notice we said possible. You can pause your video player here. This quote would align with what we believe to be right now as the base case. And the charts that we just covered in their present form align still with scenario 2. That could change very, very quickly because we're near all of those inflection points. We could quickly start to take on a scenario 1 look. If the S&P 500 breaks out, the longer the breakout holds, the more relevant it becomes. And if the breakout attempts in the bond market or the bonds fail at potential overhead resistance, then we could be looking at a continuation of scenario 3. The Federal Reserve has been raising interest rates at a very rapid pace relative to history. Policy tends to work with a lag. It takes time to work its way through the economy. If the base case holds, then earnings in the labor market should get hit next. They still look pretty good. This would align with scenario 2, and this is really concerning in the present day. Stock market has rallied sharply off the lows. A lot of times that happens at a major low when the market's looking ahead to better days relative to the economy and earnings. We really have just the opposite right now. The probabilities say the economic outlook should deteriorate, and right now earnings estimates are falling as the stock market is rising. And hence, stocks have been getting more expensive rather than less expensive, less attractive as they continue to tick higher. You can learn a lot from stock-bond ratios relative to the scenarios walking forward. It's possible that the bond market, especially TLT and IEF, it's possible they act differently relative to history because investors are concerned about the explosion in government debt. Don't assume anything relative to history in this environment. This is improved, and we've been ingrained that rate cuts or falling interest rates, it's good for risk assets. In a bull market, when rates fall, typically that's good for risk assets. But not necessarily the case if we're moving into a recession. Lower rates, you have to ask why are they lower? If it's due to recessionary fears and an earnings recession, then we may be looking at this scenario. We have to keep in mind, yield curve inversion. It's possible from a bullish perspective that that's the market's way of looking forward and saying the Fed's got inflation under control, and it's possible we're going to avoid a recession and rates are going to calm down. That's more scenario 1-like. Every chart that we've covered in this week's video walking forward will help us assess the probabilities assigned to scenario 1, scenario 2, and scenario 3. But we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.